Okay.
Yeah, can you hear me?
Yeah,
Yeah,
hi,
we can.
Matt. Okay, buddy, how are you? Welcome back.
Doing okay.
The green share box, if you brought any charts with you today.
Uh,
You
yeah,
just,
I will get to that right now. This is my first time using Zoom before we always had
yeah,
a meeting. Um,
so you're doing fine.
I am,
So it's a green box.
yes.
Click it, it'll show the monitor, and then you
Yeah,
just
here.
click it.
Okay, well,
There we go.
okay.
Okay.
So this is my sort of latest projection on the market. Even though before you introduced me, you talked about how I'm predominantly bullish on silver, which I am, and I'll explain what that has to do with.
All right, make it large like it was before, just a second ago, because it's pretty small on the screen. But it got larger for a minute. There you go. Okay.
Cool. Yeah, that's great. You have to go through all the pictures you've posted on Twitter, and then you have to go through
Yeah.
your social security number, and then yeah.
So you think we're there, and you're calling it a rising wedge. We're at the top of the wedge right now. You think we're pretty close to stopping right in here, right, Matt?
Well, let me go back to actually 2 weeks ago, or a week and a half ago. I was DMing you. I was telling you, there's a lot of people in the precious metals community who are really excited about all the new quantitative easing they're doing, which they are doing. Just tons of emergency QE, except QE 2 and 3 were not negative for the dollar, which seems odd. They were supposed to be, but all the money went to the ultra wealthy, and it's still happening with QE4, and that's the public isn't going to panic until they go to their bank and actually see negative rates. I don't mean like negative, but just even slightly negative rates. But before that happens, they're not really going to understand what's going on. So you can't just expect QE4, this new QE, to send the dollar down. I said, look, if we make a run at new all-time highs here, gold and silver they're going to drop pretty sharply. The dollar is going to go straight up, and that's what happened, because even against all this QE, the gold and silver market are, especially silver, because it's much more tied to small retail money. They're pretty tied to what the sentiment is in the markets right now, and especially because we're getting so close to the early election season on a long-term basis.
Okay, so you're viewing precious metals as a contra-cyclical market, negative corollary market to equities,
Even though
even
that's not,
though at times they move together.
yeah, historically, you see, when both of them are let's say we have the Dow and the metals market, and they're trading in a choppy sideways range, and there's no big news. In that case, sometimes the correlation is completely absent. There's just no correlation at all. Now, when one of those starts to just shoot up, let's say it was the opposite. Let's say right now the Dow was like 4,000 points lower, and gold and silver were just parabolic. Well, then you'd start to get the reverse of that psychology. Then suddenly people start to notice, but in choppy, quiet times, that correlation, that psychology just goes away. So it's a correlation that appears and disappears, based on context of whichever market is entering some kind of mania. And here's the thing with silver and gold. The 2015 bottom was clearly for bottom. That was a bottom for gold. I think it was the bottom for silver, absolutely, because gold's kind of been dragging, holding silver up, even as the retail market's completely been wiped out. And the corollary, or the best comparison to that is, you remember when stocks bottomed in 2009? Well, by the time you got to early 2013, let's say January 2013, people still didn't believe 2009 was the low. You had, Obama got a second term. You had, one more retail money panic sell-off, and yet, people didn't. We're at that we're at that same point with metals now, where they did bottom in 2015, but very few people believe it or are paying attention to it, especially, at institutional level. Even the public definitely isn't, because the public is, you know,
Well, I don't know. I mean, now you have guys like Dalio and a lot of people embracing gold that, you know, haven't for some time. So I think it's become a little bit more Main Street.
Yeah, well, it's been overseas buying that's been responsible. If gold was trading based on American sentiment, it would be $800 right now. Because sentiment here, you can go talk to any coin shop, nobody is buying gold here, not in America. But on a popular, that doesn't, when you have Russia and China and India and all these other countries, there'll be too many to name here. When buying there is through the roof, and it still is, that kind of outweighs the fact that here's how Americans trade precious metals. The way they trade pretty much everything else. They pile in at tops and they panic out at bottoms and look for someone to blame. And that's what happened with like the big silver bubble around 1980, the silver bubble in 2011. The next silver bubble will be the same way. You know, the public won't even start to get interested until it's about $80. So around $80, they'll get interested. And then between 80 and 130, we'll have another 70, 80% crash after that. And they'll blame people who told them to buy at $20, and they'll get mad at them and threaten to sue them. And it's weird.
Do you have a view of what's happening in the Fed funds market and repo market?
Well, I think you had, you know, a major lack of liquidity.
Right.
Mostly overseas, there's a lot of challenges, but even domestically, there's a lot of zombie businesses out there in the retail market. Like, there's a lot of brick and mortar stores. We all know every day there's some new brick and mortar store closing, but there's a lot of real estate holding trusts that hold, you know, the mini malls, the full size malls, the shopping centers that are just getting killed because you drive even around nice areas like here in the northwest side of Chicago, and even the nicest former shopping centers are like half vacant, 2/3 vacant, and you know the guys who are owning those property, they're getting liquidity somewhere. I think that's one of the big stressors right now. You know, it's equivalent to what happened in the housing market in 2007, except housing there was all sorts of things that could bring housing back. There's really nothing that can bring retail back. You know, there's not many scenarios where, unless you turn them all into minimum security prisons, which will happen eventually, but we're not at that stage yet. And that is that the problem though with the liquidity crunch and the public knowledge that we're sort of entering QE4 is we're emptying that fire extinguisher before the market is even rolled over. So if the Fed's all in and they're doing more QE, and you know, national debt through the roof, obviously, and the deficit keeps exploding, by the way. I mean, which makes no sense. This is the greatest economy of all time. Why is the deficit going up and up? We're not seeing. Go ahead.
I'm wondering with the chart that you have up here, what's going to be behind this path roadmap that you have from the top of this wedge? Is it going to be political? Is it going to be that the market loses confidence in the Fed? What's your narrative for the charts that you're showing? Besides that there'll be rats because sanitation departments won't have any money to collect the garbage.
Well, here's the thing. Tops generally they have to happen on good news historically. Or good news or quiet news. That's how it has to happen with retail sentiment. Because one of the things that people got wrong for the Obama administration, the stock market, one of the reasons it was so strong was because retail sentiment, I mean, regular small trader, dumb money sentiment, pretty much stayed bearish or neutral the entire time. And institutional sentiment got really bullish, but they kept having that benefit of QE, and that's who gets to take advantage of the QE to buy back shares, buy more stock. Now, the only thing that really causes the worst crashes, obviously, is when you have a big sentiment bubble in dumb money or smaller traders, because they're not as liquid. They don't have access to the Fed discount window. And that's why you saw like Bitcoin go to 20,000 and then drop to 3,000. And the first Bitcoin bubble went to like $1,200 and dropped to like $200. That's an example of a market. And silver, when it went to 50 and then dropped to 13, when you have that dumb money pile in, and we're at that stage right now in terms of public psychology. And the best way you can see that outside the market is well, not just watching Fox News, but if you look at the alternative news sphere, the amount of fervor around Trump and the religious fervor, not just regular confidence, but a really uh, a level of trust and faith we didn't see under Reagan or certainly not Bush, not the second Bush or the first Bush. Um, and that is really a poisonous, that optimism. That's what causes tops. I don't believe we're going to see a negative story that's going to set this up. A negative story would be a bad thing for bears because we have to historically, that's how bubbles top. They top on good news. That's especially.
So have we had enough good news? Phase
I
one
believe,
of a China trade deal, is that good enough? And the Fed put being back in action,
well,
is that enough?
I believe that it's not just that. It's the president himself tweeting and essentially guaranteeing stocks are going to go higher. I mean, coming out and just saying you should buy stocks are going higher. That's something I'm not aware of any president doing into a bubble ever. And that is really as far as crowding sentiment. And remember,
I'm not
Trump's
even aware of him saying that. He said that? I know he
he
talks about the market doing great, etc. I don't remember him putting out a buy signal.
yeah, he's said many times in his tweets, and we're going much higher. And we're going much higher. And look, the market's up
Oh,
again,
okay.
it's going higher. He said this very, very explicitly many
Okay.
times. And the thing is, that is that's just crowding sentiment even more. And I don't think he realized, his own stock went to zero in the last financial crash, Trump Entertainment, TRMP. And I don't think he really gets like Kudlow being in the White House right now, they don't really understand that it's the optimism at the top that causes the crash, not some negative thing that just appears. If you look at 1929, the 2000 tech bubble, 2007, you look at now, it's the optimism is what causes the crash. Now in hindsight, they blame manipulation or a certain demographic. I mean, you talk to a lot of people after the 2008 crash, and they'll insist, well, that's because poor people got loans on houses and they shouldn't have got them. And the subprime, and now it's better because they're all renting the houses they used to own. By no means is that
Yeah.
better. There's an
Better for
article.
the hedge funds. Yeah.
Well, there's an article a few
That
days
bought
ago
them.
about how the top 1% are on the verge of owning more than the bottom
Yeah.
50%. But also there was a graph in there about generational wealth, and it showed boomers, millennials, Gen Xers. And here's the thing. We know millennials are broke, and that's why the car industry is suffering and real estate's suffering and restaurants are suffering. But also in the same graph, Gen Xers have less than half the wealth of boomers. And Gen Xers are in their 40s. If they're not rich now, especially with the market at all-time highs, when are they going to be? Like, we could have all those excuses why millennials aren't rich. It's because of the
Student loan debt.
yeah, that's another thing too, that Trump's really setting him up for a failure in the election. He has no student loan plan, no health plan other than just get rid of Obamacare and we'll start over, wipe the slate clean and go back to before Obamacare. And he really has nothing to attract young voters at all besides saying, look, the stock market is up, you should go buy stocks. Or it's everyone's rich because the market's up, which again is something he probably thinks. But there's another statistic. I've posted this a few times on Twitter. 84% of the stock market shares are owned by the top 10%. That's who owns 84% of the market. So in terms of volume, and that is you could drive the Dow to 50,000, 100,000, and most people are still going to be broke. The vast majority will still be broke, and it's not. He's putting all his eggs in one basket on the stock market, and he's going to make it the centerpiece of his campaign and the centerpiece of his.
Do you have a
And
number on your rising wedge that would activate it and be a breakdown that would make it actionable?
yeah, let me actually pull up one more chart, which is important because I'll show you why is this 1 year wide. This is a 1 year wide wedge, by the way. A lot of people on the markets, when I've seen technical analysis lately, they've been pulling up the daily chart. And the daily chart, if you zoom in, it kind of looks like a bullish ascend. If you go back just to spring, right? It looks like we had like a kind of a bullish ascending triangle when we broke out from it. But pull out to a year, basically, then you're talking, because yes, it goes all the way back here to, about October, November. That's where it looks like a wedge. And I think a lot of participants in terms of technicals, they're focusing too much on the daily chart and looking at that triangle breakout. Whereas if you pull, obviously, out to the weekly, it's a wedge. But that's
where would the breakdown be on that, Matt?
Yeah, that's a good. Well, if you look, I'll just zoom in.
I mean, that's a thick blue line. It could be like a 50 handle line. So it kind of looks like 2,900, 3,000, something like that.
It's not really letting me zoom. This is the
okay.
first time I've used Zoom, but let me bring up the other, the kind of an important chart, and that is, let's see here, gallery. Oh, where's Twitter? Where's Twitter? Here we go. Jeez. Okay, here we go. Yeah. Now this is really fascinating.
Enlarge it, please.
Okay. If you go all the way back to 2009, I remember emailing people back in 2009 about this falling wedge. There was this big falling wedge in the SPY, as you can see. Yeah. It doesn't look exactly like the wedge we have now, but it is sort of. It was on the same time frame as a weekly chart.
Okay.
And we had the sort of a complete inversion of sentiment. I would argue that small retail bullish sentiment is more crowded now than bearish sentiment was then. 2009, people had just given up. People were not emptying the ATMs in March 2009. They weren't lining up, panicking. It was just, they had just given up at that point. You didn't have the emotional,
they were in shock.
Yeah, you didn't have this bullishness like you had now where, and again, it's that retail, institutional money generally does not cause crashes. What causes crashes, again, is when the smaller money piles in. And even in 2007, you didn't really see that smaller money in the markets. You saw it in housing. They were all flipping houses. It still dragged the markets down with them because real estate is such a correlated asset to stocks. And that always aggravates me too when people say, well, buy hard assets, buy real estate, buy gold, buy silver. Wait a minute. Real estate, first of all, highly correlated to the stock market. You get a 40, 60% stock market drop, you're out of your mind if you think real estate is going to stay exactly flat or go up. Secondly, obviously, there's depreciation and there's taxes on it. You buy gold or silver, put in a safety deposit box. You're not required yearly to go right out to the IRS. Okay, I have this amount of silver or gold stored. Here's my property tax for the year on that gold or silver. And property taxes in all the good real estate markets are through the damn roof. And that is it's like a reverse dividend. So this idea that doesn't even include maintenance, insurance, all these other things you have to do when you invest in real estate. So when people just say, well, invest in hard assets, well, cars, wine, housing, all these things are fragile. They depreciate easily. Gold and silver are very, very durable and very easy to maintain. And they don't have that element of, that tax claim until you go to sell. And even then, if you're selling physical, if you're selling, like, say, American Eagle silver coins or American Eagle gold coins, there technically isn't even a tax reporting requirement. So it's you can kind of see why the Chinese, the Russians, even a lot of wealthy people in the U.S., why gold and silver are in a different class. They're not just another hard asset in terms of durability, in terms of liability. It's its own world in that sense. And
well, it's liquid too, unlike real estate.
That's another thing. It's very liquid. Yeah, if you have to get out of your house real fast and sell it, my God, in the middle of a panic, you will not be able to sell it to anybody.
Even in good times.
Even in good times, sometimes you get marooned.
It takes time. Yeah.
And the thing is, again, well, why not just short the market directly? Well, here's the problem. I think once we're down about 25, 30%, I think the first 20% down on the market will be slow and choppy because people think the Fed's got their back. Trump's definitely going to win in 2020. So they're not going to panic when we're down 15%, 16%. They're not going to garden variety pullback, ride it out. It's not until we're down like 25, 30%. then they're going to think, oh God, Warren's going to win, or whoever some Democrat I don't like is going to win. Or then so the move from the first 20% will be slow and choppy, very slow. It might take months, but that move from around 25 to 30% to like down 60%, that will be a lot faster. But then you get this weird intervention factor. Will the Fed will come in somewhere north of 23% down, 25% down, and they'll do negative rates. And the day that they do negative rates, it doesn't mean stocks are going to go straight up and make new highs. But if you're directly short stocks, you'll lose half your profits like in 2 days. You'll be sitting there shorting stocks. You got the exact top. They do negative rates. Suddenly, you've lost half your profits in a blink of an eye. Whereas gold and silver, obviously, it'll be rocket fuel for them. So gold and silver are they're immune to this surprise ambush from the Fed, which would be
Well, we've had about a $2.70 pullback in silver, trading 1683 right now. What are your buy zones in this pullback?
I think anywhere here in the 16s, I think it's a buy right here.
Okay.
And
Okay.
I said before when we were in the 18s, I said, look, this market has a coin flip chance of breaking higher. If it does, gold and silver are going to get killed. And I really think people, you have to really trust your sources on gold and silver, because there's a lot of people in the silver community that are so into the narrative of manipulation, and every sell-off is manipulation. And it's like, what did you expect silver and gold to do if the market made new highs? Did you seriously expect them to just go up with the market and expect the dollar not to go up and yields not to go up? The manipulation narrative is so toxic, and it's really sort of a self-inflicted problem in the silver community, and a lot of it, frankly, I'm not going to name names, but a lot of it is to shield people from the fact that they were bullish on silver at $50, and now ever since, they have to tell you every sell-off was manipulation. This was intraday. If silver has a sell-off on a 5-minute candle, that was manipulation, they'll tell you. And it's like, I'm sure there's some institutional shorting. There was, in 2011 that it was on record, but
well, everything's manipulation, isn't it?
Yeah,
I mean, isn't financial engineering of corporations borrowing money in the corporate bond market and buying back their own shares manipulation? Only they call it buybacks.
It does happen occasionally when some whale or some big institution comes in to push around the market, but when you cry wolf on it, as they do every sell-off, then that's really not helping anybody by crying wolf, because then you won't know when the real manipulation's happening. If you can't tell me every tick down is manipulation, and I'll tell you, I kind of, when we started the interview today, I didn't, how I even got into trading. I was on the police during Katrina. I'm not going to give the whole story again because I've given it before, but that experience did sort of affect my trust levels in the institutional elasticity, or its ability to weather problems. I mean, we never had that moment in 2007, 2008. We didn't have the ATM shut down, or major third world type unrest. But will we have that after the next decline? Yeah, especially because of all the scapegoating. The right's going to blame the left's going to blame the right. We already saw a few months ago, Trump wants to declare Antifa a terrorist organization. Whether or not you like Antifa, it's a very decentralized organization. It is extremely going to war with Antifa would be the drug war all over again. It would be the same vague, there is no, it would be a nightmare in terms of just, and they'd love to do it because it's more excuse to spend, military industrial money and law enforcement money, and just have an endless stream of that out there. And they're always looking for, if terrorism, if we don't have enough terrorism, they have to create something else or some other target. But, this country, and Americans have a lot of it is the culture of convenience we've had. It's not just boomers, it's also their kids. And it affects how we trade markets. That sort of drive-through mentality of, when the market's up, get me in. When the market's down, get me out right now. And a lot of this is why we have such horrible surges and crashes in this country. That sort of mentality of that impulsive panicking at the highs, panicking
Well,
at,
I don't,
panicking at the
man,
highs,
really, I have
panicking
to
at the lows.
push back a little bit on this. It doesn't only happen in this country. You've had, crashes going back to Tulip Mania was in America. Okay, so it's just the nature of markets that you have euphoria, you have despair, and everything in between, in my view. What do I
Well,
know? I'm just a blind squirrel in the middle of a snow-covered forest looking for a few nuts, but that's my belief. It's not limited to America, that these market phenomena are universal.
well, the only first world country I'm seeing right now where the leader is basically by a certain subset of the population, a large subset, where it's being sort of conflated with religion. The Trump prophecies, the QAnon. I don't see this happening anywhere in Europe where you have a leader. You do have populist leaders that are rising up.
Well, you were talking
They're
about
not being,
markets crashes. I'm just talking about that. The markets. I don't care where it is. If you pull up a chart and you look at history, you'll see that all markets go through the same kind of phases. That it's a universal cycle rhythm. That it's not only America. Will you agree with that?
there've been some really
Yeah,
bad stuff in the bubbles over the years.
everywhere,
I agree with that. I
everywhere.
think,
How about Japan in '89?
well, if we had a crash in the currency and the stock market like Japan, we would
Well,
have.
I'm just saying. I'm not saying. I'm just saying that that it's not just how Americans look and trade and invest that these types of things happen.
Right, but I'm saying they're more culturally, I guess, elastic. They could take the impact better, and
Okay.
we don't handle problems as well here.
So I agreed that the boomers are an untested generation.
Well,
Up
it's not
until
just it's the
2008,
younger.
a lot of
Yeah.
them have been tested since the Great Recession, which wasn't so great for a lot of people.
Well, it's and there's a lot of people attacking the boomers, but I'm saying the younger generations too. They have that same culture, at least in America. Well, if something goes wrong, I'm going to find someone to blame. It's definitely not
So,
myself.
okay, we're getting close to a wrapping here, Matt. So, buy breaks in silver. You think the $16 level anywhere in there is okay. Are you looking to perhaps short equities, buy bear funds, or is your investment thesis just keep buying breaks in precious metals?
Since the ride down is going to be so bumpy in equities, I think if you're going to short, you have to be a day trader. You can't. The real juicy swing shorts probably not going to come till after like 25% down, and then you're going to be playing chicken with the Fed, who's going to come in and do negative rates. We're down 30% or 40%. You won't know what day it is. So I still think buying metals is the safest way because you're insured against that sudden attack from the Fed, and it will be sudden when they announce negative rates, just like when they did all those interventions in 2008. So I would lean towards buying silver as a short on the stocks. I mean, you're buying it because you're bearish, and I think
Okay, fair enough. So, precious metal bull at Panama Orange, man, is that the best place for people to follow? You do really make some pretty cool charts with your pictures, and yeah, they're all great macro looks. People that look at them are going to have to fine tune it for them to be actionable. But I appreciate you keeping me informed on Twitter, and I'm always glad to retweet your work. Keep it up.
well, I appreciate the promotion of my Twitter stream. I'm also on Stock Twits where I have
Same handle?
same handle. I have way more followers on there, like 20,000 something followers on there.
Oh,
High
well, they'll
20,000.
all want to hear this. So the video for this interview will be out in a few hours, buddy. And thank you for being with us again, Panama, and appreciate your viewpoint and congratulations on luring people to buy, including me, to be buying silver right around that $14 level. So thank you
Yeah,
for
just
your work.
buy generic at a reputable dealer or your local coin shop. You don't have to buy any particular kind of coin. And I'm not endorsing any particular dealer. SD Bullion's good, Providence good, but your local coin shop, if they will sell for $1 over spot or less, usually that's the best you can get. That's fine. So that's very simple process. You don't have to go find a certain exotic coin or a certain dealer. You just go call your shops. If it's $1 over spot, that's a good deal. If it's 150, walk away, call another shop, because some of them will do 150, 175, and that's just don't use that shop. That's unreasonable.
Okay. Well, thank you again, Matt. Good luck this week and going forward, and appreciate you showing some wedges here today.
Sure. Well, I mean, it was mostly a fundamental talk, so I only brought 2 charts, and
That's
I hope
fine.
even I again appreciate you having me on, and I hope I didn't go too long-winded and go over some more.
I appreciate your time. Thank you, Matt. Good hunting, my trading warrior brother. That's going to be a wrap for us, everyone. And remember, don't just count your silver bars or gold coins, count your blessings. And we'll see everyone tomorrow for Turnaround Tuesday. Thanks again, Matt. Adios.